you buy blue chip large corporations. That reduces your risks, and that's all what counts long term. Forget about recessions, forget about what masses are buying, forget about the volatility. It should serve you. If the markets go crazy, and who cares if your stock jumps up and down, don't care about the price change every day, who cares? The don't care, you shouldn't care about the funds, what they do. They look at the index, and just the funds follow the index. I mean, that's, you don't even have to look at the Dow Jones. I mean, who cares? If you have strong companies, it doesn't matter to you what the index is doing. If the market goes brutally down, it's your time, it's the best time, it's like a gift. If the market goes up, it's great too, because your stocks go up. And also, if you buy and pick a company, just mostly people make the mistake, they look at the revenues and earnings, that's all what they do. Look also at the cash flows. The cash flows tell you more about the quality of a company. Do you know Enron? That was a scandal, it was a scam, and they never made a lot of free cash flow. I don't know if they made any cash. Or green coffee, this green thing, this coffee roaster, how is it called? The Green Mountain Coffee Roasters. That thing was a rocket. That stock went up and up and up and up for years, and I was surprised when I looked at the cash flow statement. Like they don't make a lot of money. In the last 3 years, one year they burned a lot, and the other years they are like increasing their capital, cashing in from the shareholders, but not making a lot of cash for themselves. So the core business is not really a great thing. So always look into the cash flow statement. Don't listen when you pick a stock to the neighbors, friends, family. They are part of the masses. They run with the themes and trends of the masses. They love Facebook. They love, you know what I mean. I mean they love Apple. They don't go for the ideas of the others. Pick your own stocks. Invest by yourself. Be patient. Think long term. To invest means on the long run to make more money than you paid. That's all what you need. You want moderate valuations, like a P ratio below 15. I like stocks below or at book value. I like also stocks that are below their revenue, valued below their revenue, 1x revenue. Market cap below 1x revenue is a great opportunity. If you have a great margin, you can pay 2x revenues. That's okay too, as long the margin, the PE ratio is in shape, is not too crazy. A PE ratio above 20, I wouldn't pay. I don't like growth companies, growth stocks. Too dangerous. Everyone loves them. The masses love them. They run after them. They buy them like crazy. I want just moderate growth. That's less risk. I hate debt in the balance sheet. Companies that are leveraged up too much, too dangerous. It creates pressure, and it's not good. It's not good for the management, for the quality. It's a very dangerous thing. So avoid that. And you also want to think about that a piece of a stock is not a lottery ticket. It's a piece of a company. So you don't buy and sell, buy and sell, buy and sell. That's just stupid. Just keep it. You wouldn't sell your company if it's doing well. For what reason? And don't follow trends. Diversify a little bit, but not too much. Invest what you know, where you have some experience. Don't invest in companies you have no clue about them, and don't have wrong expectations. If you don't want to have a dream, like you don't want to double your stock within a year. People that do that do stupid things. They just lose money because it's a fantasy world. Just Think about it. You want to make 15 to 20%, 15 or 10% is fine a year. That's all. A total performance of that is all you need. Warren Buffett doesn't look for to double his money within a year. That's just too stupid. It's unrealistic. Keep calm, keep cool. Whatever happens, emotions are poison. And also very important is the masses the masses get worried when the stock goes down. So they just do the opposite. They buy it for 10. If it goes down to 8, they sell it. You buy it at 8 and you wait. And that's your time if the masses go out. If the sun shines and it rains, so a stormy day, whatever it happens, it's part of the game. Don't get too worried. If you have quality, it doesn't matter. Your age is of course important. The younger you are, you will benefit from the compounded interest rate effect. So, but also if you're old, you don't want to waste your money and destroy it with the inflation. You also, if you are older, if you are 60, there's no reason to say value investing makes no sense. Also, your loved ones, you want to inherit a portfolio that is nicely protected and is making money, and not a CD that with inflation is eating it up. So the core idea behind value investing is just to find a great company on a great deal, on a cheap, on a depressed level. Sometimes you find those if they have problems. A great company can always have a problem. A car producer, a car company, a great name, has maybe some problems with the brakes or whatever, and so it's in the media, and every day they talk about an oil company has polluted the ocean, the beaches, and the stock is down 30%. Or you have a trading loss, a huge trading loss. It's every day in the news, weeks and weeks and weeks, and they discuss, and the CEO is under pressure, and the stock goes down. That's your time. If the balance sheet is strong, they will go through their problems, and it's a fantastic opportunity to buy in that problematic phases, and the masses are selling and selling, and there couldn't be a better opportunity for you. It's damn cheap, it's damn great. You just buy and wait, and that's all what you have to do. And don't worry, you don't want to buy a stock that is on the recommendation list of a large bank, and you don't want to buy a stock that is every day in the news in a positive way. You don't want to do that, like an Apple that is like beloved by everyone and everyone is happy with it. Of course, it's a great company, but it's on the recommendation list of every large bank, and I think the masses are in the stock. All the hedge funds are in that stock. It's something. I think you shouldn't look for it because it's a growth stock. If the growth slows down, it can happen. It's still a great stock, but if the growth slows down, the people are disappointed and running away. And then it's maybe the time to be a value investor and buy it. And yeah, that's also very important. Is just don't think about what I said before, the economy overall. Just look at the company itself. The masses love growth stocks, and you don't like them. You want moderate stocks that grow moderate, 5 to 10%, 7% a year revenue growth. That's fine. If they pay out nice dividends, if they have a great cash flow statement, it's wonderful. They buy back stocks, and that's all what you need. Also, reduce the risk if you first look at the risk and then on the performance and the perspectives. The rule number one, the risk, and watch out for the risk, avoid the risk. That's all you have to do, and you don't need a brilliant stock. It's not necessary. That Warren Buffett is not looking for a brilliant stock. He just wants to avoid losses. That's the main goal. And also, you don't want to be a genius, because you know what, you can try whatever you want. Probably the chances are very high you will not get the 5,000% stock, because if you are in that dream wonderland thing and fantasy world, you will make probably stupid mistakes and lose probably everything or a lot. Don't try to be genius, just try to be smart. That is very important, because the people out there, they want to be genius and pick the 5,000% stock. Yeah, if there's a panic, it's your time to buy. If there's volatility, your stock goes down, it's time to buy. If you think that your company is in a crisis, for whatever reason, they will get over it. If they have a great balance sheet, it's time to buy. Forget stop loss orders, because it costs money, you will be out of the game. You trade with those tools. Don't do stop loss orders. I would say forget quarterly results, doesn't matter. The yearly statements are fine. That's all you need. Forget the stock movements every day. It goes up and down, who cares? 1% up, 1% down, it doesn't matter. It just makes you crazy to look every day for it. And have fun with it. Value investing is a very great thing to do. It's a funny thing. It makes you will be happy with it because it works, and you will be happy with the dividends. You will be very happy. It's so fantastic if you own a stock 30, 20 years, 10 years. I mean, you will see it's fantastic. You will have a lot of fun. You will love the dividends that come into your account every quarter. Don't take it too serious. Accept mistakes. I think right now it's a good opportunity to buy. The Dow Jones is below 13,000. It didn't do well for 10 years, for a decade. It was a lost decade. I think it's great. Everyone is talking about the problems in the economy, about the unemployment of 8.2% right now. Everyone talks about the deficit spending and all the problems in Washington. It's a great time to buy. It's a great time to be an optimist. It's the best to be an optimist. It's read a lot, get some books about Warren Buffett or John Templeton. And my last advice for you is don't spend a lot. I mean, Warren Buffett buys old cars, used cars, 10 years old. He doesn't give a damn. He doesn't need a brand new Mercedes. He would never do that because he's a value investor and he's not a spender. He goes in cheap diners. He doesn't give a damn about a luxury meal. And John Templeton went camping with his family. There, Carlos Slim, the billionaire from Mexico, drives old used cars. He lives in his house he has for decades. They are millionaires are millionaires because they are not spending a lot. And I hope my advice helps you at least a little bit. And I will post some more stuff here on YouTube, and have a great time, and hope to see you soon. Bye.